All right, Yield Nerds, episode 133. The excitement is in the air. The bond hunting season has officially begun. I will tell you more about what I am doing to capitalize on what appears to be the first rate cut headed our way. You do you. Couple of things. We are up to 360 something subscribers. Thank you for your support. If you're new, please remember to use the playlist called the Income Investing Roadmap that organizes the show. And don't take my word. Please remember to check everything you hear here on your own. Well, four parts in this episode: the market temperature, and that is me trying to get ready to go bond hunting for real. And what does the first rate cut mean, and what does it mean to bond traders? I'll explain a little bit of my perspective. And I'm going to create a simple filter to look for bonds that qualify my criteria and start buying them, because now is the time that I believe is very, very suitable to profit on bonds. And I'll review my trades. So the wheels are turning. Here's what I mean by that. The rate of return, look at that giant seesaw in the Russell. What was a very good game suddenly has crashed and burned. And my little portfolio is that blue line that just keeps on chugging. And in the meanwhile, here is the Dow, again a big up and down. And I'm at 1.53% something for the last 3 months. In the meanwhile, the Dow barely beat me at 1.66%. The Nasdaq, even that had a big upward trajectory and has come crashing and burning as we go towards the first rate cut. And all of this means one thing, the bond market is starting to look really good. I am at 6 something percent for the last year. Remember, that 6% is after my, living expenses have been paid, and most of that is state tax free. So you do you. I'm just showing you what I'm doing, and I still have not really bitten off a lot in equities, and that is for a specific reason. But on the fixed income side, I am starting to change my approach, and I'll walk you through that. In terms of time to maturity, as you know, the vast majority of my portfolio is still on very short-term T-bills. However, as I move towards the higher maturity areas, I have some agency bonds, but I am starting to accumulate muni bonds and corporate bonds based on the yield Super Bowl and what that has taught me. And I'll share what I'm doing there. So, what does the first rate cut mean, and why is it important to bond traders? We'll talk about that, and that is me being a bond bull, and I just hope I don't destroy too many of those eggs that belong to Calmain Foods. Well, before I go any deeper, I want to make sure you understand that I am not a wealth management advisor. This is not tax advice. This is not investment advice. I am sharing my education. Remember to use your own judgment. Well, we did some treasury time travel earlier where we saw that the yield curve went from about a year ago and shot up in October 2023 only to start crashing. Well, what is the main reason for that? It is the anticipation of reduction in short-term interest rates. And if you were the Fed, I gave you a quick primer last time, the Fed would love to drop short-term interest rates because they have to finance the debt that is maturing with short-term interest rates. And if interest rates are as high as they are right now, refinancing the trillions of dollars of debt that matures will cost a lot of money. So somewhere between now and January 2025, the reason I say January 2025 is because, surprise, surprise, that is the next debt ceiling meeting. So somewhere between now and January 2025, the Fed will need to drastically cut interest rates or face the daunting task of running out of money. And so that is going to happen. There is no question about, how much is it going to happen, how soon it is going to happen. It is going to happen. And when that happens, if you want to protect your yield, you have to find other places to park your money. And that is what I am starting to do ahead in time. So we played Yield Super Bowl. You may remember when we played it 6 months ago, we kind of came to the conclusion the entire game was in treasuries and agencies, and I certainly have a very healthy portfolio in both treasuries and agencies. But my new sweet spot is right around here. And when I say right around here, I expect all the callable agency bonds to get called within the next 6 months. And I have no control over whether that really will happen or not. But agencies are not going to pay the 6% coupons that they have been paying if interest rates drop. All of their bonds are callable, they will get called. So the smart money, which I'm trying to be, I hope to be, the smart money should go towards the next best yield option and try and figure out how do you protect your yield. And so I am going to start looking at the muni bonds and corporate bonds in the right side of the duration curve and think about what I can do different. So what does it mean? I'm going to create a filter, one for muni bonds and one for corporate bonds. Now realize I do not intend to take 99% of my portfolio and go to muni or corporate bonds. I fully expect to go into equities, except now is not the time. I will patiently wait. So, what is the filter I'm trying to use? I'm driven by a specific philosophy as I go bond hunting here. See, that's me hunting for bonds in the New York Stock Exchange. And I am not going to buy equities because I expect a bigger drop in equities, and I'm going to create a purpose for bonds. And let me explain what I mean by that. What is my thesis? I don't want to buy bonds above par. That's a criminal offense because if it gets called, then you lose a lot of money. I also, at this point, don't want to buy bonds at par. The reason I don't want to buy bonds at par is because, I'm going to make a lower coupon because interest rates are dropping, or the perception is that it is going to drop soon. So agencies are not putting the really high coupon, bonds out there. Plus, if I got something and the agency called it, my yield is really not protected for a longer period. And the first rate cut may come 3 weeks, 4 weeks later. Who knows? So, what I'm trying to do is look for bonds that are underwater, meaning they trade below par, that I expect to increase in value, especially after the first rate cut. What do I mean by that? If a bond that I buy at 96 cents on the dollar gets called for 100 cents on the dollar, that's an extra 4 cents of yield. So that is what I'm going to go shopping for. And so here is my muni bond thesis. This is from Schwab. You go to the find bonds and you can pick bond type. You set it to municipals and you say, give me bonds in, 5, 7 year maturity, anything like that. And if you remember Yield Super Bowl, that is where muni bonds had the best outcome. And that is why I set it to that area and say, give me 5 to 7 year muni bonds. I need to make a minimum of 3%. Now, that 3%, yes, indeed, is federal tax free. However, I use effective federal tax. So it's, whatever your tax rate is, federal tax rate is times three. That's the number you would get. And you would then sit there and say, I don't want to pay par. That's what I say. I want to pay something less than par with the hope that if this bond gets called, I'm protected. And the next part is muni bonds do have credit ratings. I'm sitting here saying, by the way, I don't want to buy it in a city that is about to go bankrupt. I want to buy it in a city that has a lot of cash. And you may remember the North Dakota example we reviewed the previous time, something like that. And, for fun's sake, I'm also saying, hey, can you make it excluded from AMT, alternate minimum tax? It's really not necessary, but I just threw it in there to see what happens. So to review, the conditions are muni bonds, 5 to 7 year maturity based on yield Super Bowl, a minimum coupon, a price well below par, so you have the opportunity to profit when the bond gets called, good credit rating, and AMT, whether you want to use it or not, we just take a peek and see what is there. Well, I did, and I didn't particularly find anything that jumped out. And the part that happened among those that qualified, and I'm cutting to the chase here because I want to spend more time on something that does qualify. Here are a couple that qualified on the muni side. There is a Harris County, Texas muni bond that qualified. And it pays 3% and it matures in about 6 years and all that kind of good stuff. However, in the last 2 years, this has only changed hands, oh, I don't know, a dozen times. And when I see that really low trading volume, I get worried for a very simple reason that, and here's another example from Florida, and again, you can see that there aren't a lot of trades. If there aren't a lot of trades, I don't think I'm perfect by any means. I make mistakes. And if I made a mistake and I want to get rid of whatever I bought, I want to make sure there are a lot of buys and sells so I don't sell it at a deep discount to what I bought. And so that's my worry with the muni bonds that I see here. And so I wasn't really excited about any of the other muni bonds. I did buy the North Dakota one, you may remember. And the reason I bought that is very different. So North Dakota Barn City, this is a correctional facility, and the city itself has very good finances. They pay 3% federal tax free, but in reality, because it's trading at a dirt cheap rate, 70 cents on the dollar, you really are buying 4% of tax-free coupons for 3%. And hey, I don't think it's going to get called anytime soon. However, I do expect it to appreciate from 70 cents on the dollar when interest rates decrease. I do not plan to hold that to maturity, but if I have to, I suppose I'm getting 4% tax free. That is the way I think about it. I couldn't find anything else that had high trading volume and met all of these conditions. And even when I looked at Barnes, North Dakota Correctional Facility, I do see some trading volume and it is at an increasing level. My bond is already up 7% on what I bought. So, once it goes up a little more, which I'm hoping after the September rate cut, it keeps going farther up, I might just get rid of it. Who knows? We'll see. I certainly don't plan to hold that to maturity unless I really have to. So, where do we go next? I'm going to turn to corporate bonds, and something interesting is happening here. I'm going to stick with my value investing principles. What do I mean by that? I will buy bonds in companies that are in the consumer staples industry, in healthcare and utilities. These are the most defensive sectors. And so I'm going to say, number one, I'm going to stick to those sectors. And so I will go look for bonds, pick corporates, filter by sector or industry. This is a Schwab feature. You should look at your own brokerage to see what that is and pick those defensive sectors. And then I'm going to say, oh, I'm willing to go up to 20 years. Let me just see what's out there. And the reason you want to go really far is because you want to buy a bond that you hope that the corporation calls. And I'll explain more. Well, now I'm saying, well, I'd like to make 4.7% or more for 20 years. You may remember the treasury rate for 10 years is under 4%, it's 3.5%. So, who in their right mind would give you 4.7% for 20 years? Probably nobody. And the only reason this is priced that high is because this bond, whichever qualifies, must have been issued during the depths of COVID. There was a very nice premium over the existing rate, interest rates were high. And so I want to make a coupon of 4.7%. And I'm also, a very smart bond investor because I don't want to pay above par. You can get a lot of muni bonds, a lot of them that pay 5.5% coupon. And you would sit here and say, oh my God, it's tax free, 5.5%. But the bonds will cost 112 cents on the dollar. And that is useless in my opinion. At least I don't plan to buy them. I like to buy below par. So this is 72 to 99 cents on the dollar, except they have to pay a very high coupon. And oh, by the way, I'd like the company to also be financially very sound and have a good credit rating. And you sit here and go, what kind of company with a good credit rating would pay a 4.7 coupon for the next 20 years and keep paying it, and for whatever reason their bond is trading below par? Well, that's what I want to find out. And I want all of the credit agencies to also think that they are a good credit-worthy company, and then I'll do my own diligence. And when you run that search, drum roll, I'm sorry, I forgot to also say there is a concept called yield to worst. Now, yield to worst is a very important concept if you buy above par. Let's say that you bought a $100 par bond at $102 and the bond got called the next day. You lost those $2. That will hurt your yield really badly. Here it says because you're buying it below par, I want my yield towards to be at least 5%, which is pretty cool. And I'll hold it to maturity if I have to, but you need to pay me 5%. So this kind of makes it easy for me to hold the bond to maturity, and I want to see what comes out. And so when I run the search, I get these 5 or 6 bonds that qualify. And notice all of their coupons, surprise, surprise, are 4.7% or more. And they mature 20 years out, except, a couple of these. S&P thinks it's a BBB rating and Moody thinks it's an A rating. And I go, I don't know. I kind of want both of them to think they are A something. In the meanwhile, I then go around and look at the qualifying companies. And what strikes me is that there are 3 companies all in the pharma industry, which is a pretty defensive industry. Even if we have a recession, people are going to take their pills. And so AbbVie, Merck, and Gilead Sciences, all 3 have bonds that qualify the criteria that I put there. And so my mind goes to, let me see which one is the best of them all, and I'll pick them. And so I put AbbVie, Gilead, and Merck on a comparison. This is using Schwab. And the first thing that strikes me is that the long-term debt to equity is high for all of them. But remember, you are buying the debt. You're not buying the equity. And AbbVie, please, you do you. I'm not a wealth management advisor, but a debt to equity ratio of 856 sounds a little iffy to me. And then I start looking at, gee, what is their PE? Again, this is even higher than software companies. So Merck has a P ratio of 21 something. The others have an insanely high P ratio, which either, in my opinion, means the stock is priced too high or their earnings is too low or both. At least that's what the market says. You do your own research. And so far, the only one that is palatable to me is Merck. Lower debt to equity ratio, reasonable price to earnings ratio. And then you start looking at earnings per share growth. And again, AbbVie and Gilead have problems. And Merck seems to be growing so fast, it's unbelievable. And then you realize, oh, what is happening to Merck? Well, Merck just made an acquisition using the funding from the bond, and it is the acquisition that is pushing up their earnings. And you go, so I am funding the fact that Merck has higher earnings. Then you look into the dividend coverage ratios, and you notice something. Please do your own research. This is telling me that AbbVie isn't even making enough money to pay its dividends, so they have to dig out of their cash pile to pay the dividends. Gilead is in a deeper hole to pay their dividends. Merck, with the new acquisition, will have no problems paying its dividends. At least that is what this says. Then you sit there and go, okay, I know the long-term debt to equity ratio, even 79 is high, but we're buying the debt this time. The debt to capital ratio is again very unhealthy for the other companies. And so you say, tell me more about this Merck bond. Let me get to the bottom of it. And you see what is happening. The Merck bond was only issued about a year-ish ago. And a year-ish ago, the federal funds rate was 5% or something to that effect. A corporate bond at 5%, people would laugh. They would say, wait, you're not giving me a risk premium. And Merck would say, but wait, I'm going to give you 5% for the next 20 years. Hint, hint, small note, it is callable. So according to Merck, if I was Merck's board, I would say, look, we need money to buy this other company. We're going to issue the bond at 100. We'll just buy the bond back when interest rates drop. Well, interest rates did not drop. Since May 2023, interest rates went up. When interest rates went up, this bond crashed. And then there was talk about, well, maybe we'll start decreasing interest rates. And we had this giant bull run in the market at the beginning of the year, you may remember. And then once again, there was all this melodramatic stuff of, oh no, we are overheating this, that, and the other. And the bond seems to be kind of in a little bit of a jam in the last 3 months. So I'm going to put a little microscope in the last 3 months to understand what is going on. Because the last 3 months, the direction is pretty clear that there will be some kind of an interest rate cut, maybe more than one. And if you put just the last 3 months in focus, magic is happening in that bond. That bond is very rapidly catching up from 92 something to its callable par value. And so buying that bond below par, in my humble opinion, you do you. Even if you have to keep it for 20 years, you get to make 4.9%. And if it is called, you get some extra cash. So let's think about what that means. And I'm going to do a quick primer on what that means. You pay $100. 6 months later, Merck pays you $2.45. Another 6 months later, Merck gives you back the $100 and the $2.45. This would be a 1 year duration. Except Merck is not doing this. Merck is going to keep paying you $2.45 for the par value of 100 every 6 months for 20 years. And at the end of the 20 years, Merck pays you back the $100 and the very last payment. That's pretty simple, I understand. Wait, one minor detail. You didn't pay $100, you only paid 96, give or take. If you paid 96 and the $96 made 245 times 2, which is 490, that is the same as making $5.10 because you didn't put 100, you only put a 96. So your yield is not 4.9%. Your yield is higher than 4.9%. It's more like 5.1%. How interesting. Sign me up. Let's dive deeper. So we look at the bond and you realize the coupon is 4.9%. This is from Schwab. And you see how the 4.9 is paid in 2 installments of 2.45% each. And you also see that the bond price is 96 something. You see the yield to maturity, this is what we just reviewed, is 5.1 because you didn't pay the full price, you paid 96. And yield to worst. If you buy a bond below par, your yield to worst will be the same as the yield to maturity. And then the yield to call, it says, is 5.1, and that is an error. So I called Schwab customer service, walked them through it, and said, I'm sorry, your yield to call is incorrect. And here is what I mean by that. If you bought a bond at par value for 100, they paid you that 245 every 6 months and gave you back the 100 after a year, you would have made 96, you would have made 4.9% on yield to maturity, and your $100 came back. Except if you bought it for 96 cents, it would be the same as 5.1%. So far, so good. I'm in agreement with Schwab. The one thing that Schwab did not take into account is, hey, wait a second. When Merck bought that bond back, they did not pay me 96, they paid me 100. So you have to add the difference between the discount and the par value back into the yield to compute yield to call. And so here is my buy. Surprise, surprise, I did buy that. I bought it at $95.93. And if I were to find a yield to call calculator, and I'll post a link on YouTube, if I were to put a yield to call calculator, and I bought something for $95.93 that matures for 100 in 1 year, and it pays 4.9% twice a year, which is 2.45. The yield right now is 5.1. We're good with that. What do you think the yield to call will be if Merck were to call the bond in 1 year? Now, I don't know that they're going to call the bond in 1 year. It may take 2 years, 3 years. I don't think they're going to let it mature. I wouldn't if I were on Merck's board. If interest rates drop to 2 or 3%, I would just issue a new bond at 3.5%, pay off this bond because it makes no sense. Guess what the yield to call is if Merck were to call the bond? Surprise, are you ready? 9.255%. So that makes a very interesting play when interest rate cuts are about to come. I anticipate some of these high coupon bonds to get called, and that is where I'm going to go on a bond hunt. So what are my trades? Yes, I bought that Merck bond. I'm excited about it. It's already up. And as far as my equities, I only own smidgens here and there, but it's the same old, same old. I'm buying more TK tankers and RCAT and stuff like that. RCAT is my top banana. It has appreciated tremendously. And then I have Calmain Foods and Tenet Healthcare and Intuitive Surgical I have a couple of preferreds that are also, at the moment above what I paid for. I am getting punched in the face on my energy stocks, but I'm just going to hang tight. These have phenomenal return on investment. So I'm just going to collect the dividends and sit. Hey, remember, even a broken clock is right twice a day. Make sure you do your own research. And thank you for watching YieldNet.